everyone. We're going to talk about Chapter 16. Chapter 16 talks about managing assets and liabilities for companies, and we're going to get into how companies fund their expansions or fund new products. And there's two ways they can do that. That's through debt or owner's equity. So we're going to end this chapter up talking about owner's equity, talking about stocks in a company, owning stocks, and purchasing stocks through the stock market. This is all very, very important because it is pertains to our next project, which is the stock market project, which begins this week. It's usually a fun project. It's not horribly time consuming. The beginning part is the hardest part because you'll be picking your stocks, and you only get to pick 5 stocks. You have to do a little bit of research, decide what you want those stocks to be. Each of the 5 stocks have to come from a different sector. The assignment is really well laid out. It's easy to follow. If you have any questions, of course, please contact me. But all the information is in the assignment. There also is a sample project from a past semester where a student did just a really good job. So I encourage you to thoroughly read the project that's posted on Moodle. Also look through the sample project that's there. You cannot use the sample project as your template, but you certainly can look at it to get an idea of exactly what I'm asking for. Then you'll follow these stocks through the next 5 weeks. Although this isn't a long enough time to really get a good reading on stocks, get an idea if they go up or down or why they go up or down. But the most important part as business people is that you start following current information on the news, in the business news. You need to be aware of what's going on in the world. So let's get started, and then you'll need to move right on to your stock portfolio because you'll need to have decided on your stocks by this Friday and decided how many of those stocks you're going to choose. You have an imaginary $10,000 and that's the maximum amount of stocks that you can have in your portfolio. I tell you it's an imaginary amount because a few years ago a student came to me after class and said, "Ms. O, I don't have $10,000 to invest in the stock market." You don't have to invest $10,000 in the stock market. You have to pretend like you're investing $10,000 in the stock market and then in 5 weeks see whether it's gained or lost. Your project is not graded on whether you've gained or lost money. It's graded on how organized and well done your project is written. So let's get started. First I'm going to take a quick minute to talk to you about current versus long-term, both assets and liabilities. Back in the accounting chapter, I talked to you about assets equals liability plus owner's equity. Assets are what you own, liabilities are what you owe, and owner's equity is what you have invested in the company. So assets, what you own, liabilities, and owner's equity, how you paid for it. Did you pay for it with debt or did you pay for it with investment from the owners? So current assets and liabilities are those things that are going to happen within 1 year. Long-term assets and liabilities are things that happen in longer than 1 year. Current and short-term are the same thing. So if you talk about short-term assets and liabilities, you're talking about something in 1 year. If you're talking about long-term, something in more than 1 year. And why do we separate those? Because as you're looking at your budgets for the next year, as you're looking at your assets and the liabilities, the short-term liabilities, you need to know if you're going to be able to pay your bills in the next year. What's going to happen? Are you going to have enough revenue to offset the bills you owe? Are you going to need to borrow money? And so we look at that short-term information very closely. If it's over 1 year, we still need to look at it very closely, but you have a little longer to get your ducks in a row. So short-term is stuff that happens now, current stuff is what happens now, long-term is later on. So current assets are your cash like when I talked about cash earlier, I told you that it could be checking accounts, it could be savings accounts. So cash is all of that money you have access to. Short-term investments, accounts receivable. Accounts receivable is money that other people owe you. Accounts that we are going to receive money for. Inventory is a short-term asset. because if you needed to get money fast, you would just have a fire sale and sell a lot of inventory. Office supplies, cleaning supplies, anything that you can get money for quickly. Current liabilities are those monies you owe quickly. Accounts payable, money you owe for trade, like product inventory, salaries, taxes, short-term bank loans. So a company has to make sure that they have enough money from their short-term assets to pay their short-term liabilities. Companies need to manage their cash. They need to keep track of exactly how much money they have. They need to make sure they have enough money to pay things quickly. Many companies have what's called a lockbox. Most credit card companies have a lockbox where you send your money or you pay bills online, and then they can speed up collections from customers, and that way they have that money quicker to pay debt that they owe. Companies do not want idle cash, large amounts of idle cash sitting in their checking account. Idle cash does nothing for a company. So anytime they know they have some excess cash, they invest it. Marketable securities, treasury bills, CDs, quick turnaround things, certificates of deposit, commercial papers. This says Eurodollars. Sure, I don't know enough about Eurodollars to recommend we invest in that, but if I was the financial manager for a company, I would certainly research all short-term investment possibilities so that I could have our idle cash making money. A lot of companies make almost as much money investing their cash as they do in selling their products. Accounts receivable, I've talked to you about those. I talked to you about accounts receivable are the money that other company owes us. I'm talking about short-term assets here. Cash, accounts receivable. Lots of companies make most of their sales on credit. I did some research last year on John Deere Corporation, you know, the guys that sell the big green tractors and all that kind of stuff. They're like 92% of their sales are on credit. So they make as much money off of interest on credit as they do off of the sale on the product, sometimes more. That's why sometimes car companies will give you a better deal if you'll finance the car through them, because then they get the income off of that interest as well. So companies do a lot of things to get people to pay those accounts receivables to them. They give discounts for early payment. It's called terms. I think we're going to get to terms in a later slide, but I'll go ahead and describe it to you here. If you have terms that are 2, 10, net 30, it means if you pay within 10 days, you get a 2% discount. If you pay within 30 days, you pay the full amount. And if you go longer than 30, you usually pay a penalty or some interest. So 210 net 30 is a very common terms, and so it gets people to pay their bill within 10 days as opposed to 30 days. Credit card companies have terms. If you pay within their 30-day limit, there's no interest. If you go over 30 days, there's a lot of interest. So 210 net 30, it might say 1, 5, net 15, which means you would get a 1% discount in 5 days. You owe the full amount in 15 days. This is called terms. It's a common way of managing accounts receivable, or if you're a company that, oh, that didn't look pretty. If you're a company that owes money, then you want to pay within your terms so you get those discounts from other companies on the money that you owe.